Okay, welcome everybody. We're going to go ahead and jump into our meeting tonight. Before I introduce our guest speaker, I do have a few announcements to go through, some housekeeping stuff just to share with the group. To let you know, hopefully you've seen a lot of these communications already, but I wanted to highlight some of the things that we do have going on right now. First off, there's 3 meetings I want to call to people's attention if you're not aware. The first one, TriVest has come to us. Well, they've opened up a WeFunder opportunity, and they've come to us and asked us to share that with the community to see if people want to get involved with being part owner of TriVest. They are going to hold a mound visit kind of webinar on Thursday, June 30th, so this week at noon Eastern Standard Time. If you check our emails, I think Jim has another email coming out tomorrow. I'm sure there'll be details in there on it. Additionally, Rise 48 has a deal that they have brought to us to share with the community. There will be a webinar on the Rise 48 project on June 29th, this Wednesday at 2 p.m. Eastern. And just the highlights on this one, if we aggregately come up with $500,000 or more that we invest in as left field community, individual terms will go up to from a 7% pref and a 70-30 split to an 8% pref and an 80-20 split. So they're doing kind of a double premium for us as a community if we meet their thresholds. So there'll be a webinar on Wednesday at 2 p.m. on that. And the third meeting is MAG has opened their Fund 1 now to invest in triple net lease deals with them. They're hosting a webinar for our community on July the 8th at 2 p.m. Eastern Standard. And the highlights on their program is if we raise $1 million aggregately from the left field community, then people's individual investment preferences will go up to a 9% pref for the community. I think it starts at an 8. And if we happen to reach a $5 million threshold, the splits improve. But they'll talk more about that as well on July the 8th. So 2 meetings this week, $1 million on July the 8th as well. Additionally, I wanted to share, if you've been out to our website this week, we actually have added 2 new preferred partners to our website. If you go to the preferred partner page and you scroll down towards the bottom, we have 2 infielders actually that are now on our preferred partner list. One is Jameson Lett, who has spoke at our meetings and done some conversations for us. Jameson specializes in building custom life insurance portfolios that he's now going to be on our preferred list. And then Pat Willis from Divergent Financial. He is also on our list now, and he is going to be helping people who have an interest in crypto and digital assets. Also wanted to share that passiveinvesting.com will be having investment opportunities in multifamily, self-storage, car washes, hotels, and real estate. They're coming up with a debt fund soon. So we'll be talking with them about that as well. And lastly, some technology updates for everybody. Effective this Wednesday at 10 a.m., that seems very precise, we are improving our website. That will include a new forum, new automatic membership renewal, new navigation, and easy profile updates. So Jim has been working with a third party to enhance a lot of our technology, and they are ready to roll some of that out this Wednesday. So more to come on that, or you'll see that. One last technology note as well, we utilize the software WonderMe for our networking after our meetings usually. And up till this point, those have only been available to use on your computer. WonderMe has now added a mobile capability. So for those of you that like to be on your phones and haven't been able to join on our networking, that enhancement has hit, and we'll be able to take advantage of that tonight as well. So more to come on it. All of that said, we'll tuck that aside, and I will introduce you to our speaker tonight. So we've got Paul Shannon with us tonight, and Paul is kind of a jack of all trades in this space. On the active side, on the passive side, he's vastly involved with the left field community as well, with blogs that he writes for us and work on our forums. So we really appreciate that. But Paul's going to be here tonight to talk about passive investing in multifamily real estate during a recession. He'll be covering interest rate risk and correlation to cap rates, today's debt markets, how to spot a true value add deal beyond the flashy marketing, and sponsor and deal structure watch outs. But it's not all doom and gloom tonight, so it's not all negative. Paul's going to also talk to us about how he's feels bullish about the multifamily industry moving forward and why it's still a great investment for us to make. So with that, Paul, I will turn it over to you. I don't know if you have any other words of wisdom you want to share about yourself before you start, but
let's jump into it. I appreciate it, Chad. Thank you. Let me just get my presentation up and running here. Can everybody see that?
Yep, got it up and running.
All right, good deal. Thank you, Chad. First and foremost, I just want to take the opportunity to thank the Left Field Investor Group for giving this platform to me. I've gotten a lot of value out of this community over the last couple of years, and certainly looking forward to hopefully giving back through this presentation. So as Chad mentioned, we're going to discuss passively investing in multifamily during a recession. And that begs the question as to whether we're in a recession in the first place, which we'll get into. A little bit about me before that. I have a 15-year sales career. I was selling capital equipment and implants to ophthalmologists in the operating room during most of that time. I started investing in real estate in 2016. I bought my first duplex back then and decided to leave my ophthalmology sales role in 2019 to pursue real estate full time. I had the entrepreneurial bug, and I was also looking for a little bit more flexibility in my schedule because I was traveling about 80 nights a year and working about 80 hours a week. So that got old after a while. My experience in the space, I've done a little bit of a lot of things, as Chad has mentioned. I first started doing fix and hold using the BRRRR method, which essentially is buy, rehab, renovate, refinance, and repeat, and just kind of create velocity of money through pulling your money back out of deals. I started fixing and flipping homes a while back and have an active home flipping business currently as well. And obviously I do long-term holds as well. I think that's where the real benefits of real estate shine. That's both across multifamily and single family. So at this point in my portfolio on the active side, I have a little over 100 units. 80 of those are multifamily units across a couple properties. And then on the passive side of things, I love the mailbox money. I think eventually as I get older and progress in my career, I'll progressively shift more of my real estate portion of my portfolio over to the passive side of things. This conversation is going to be more weighted towards the multifamily side of things because that's been my experience. I'm in 6 passive deals currently on the multifamily side, 1 industrial deal, and I also invest passively in an ATM fund. And then overall, just regarding my sort of philosophy of investing, for those that know me, I'm more of a cash flow conservative investor versus a speculative investor that may appreciate more appreciation in deals. Really, for me, it's cash flow day one. It's margin of safety, preservation of principal. So that kind of reigns true across my investing philosophy in all asset classes. So going back to the topic of a recession, are we actually in one today? The answer is maybe. We don't really know. Investopedia defines a recession as a period of declining economic performance across an entire economy that lasts for several months. It's also commonly known that if a GDP growth is negative for 2 consecutive quarters, oftentimes that's considered a recession. But what we can look at today is some of the indicators that we have as to whether we're in a recession already or whether we're headed towards one. So what we've seen very recently is inversion of the 2 10-year interest rate yield curve. And that has a very strong predictive ability to determine whether a recession is coming. And usually when the yield curve inverts, recession follows within 6 months to 18 months, is what history has shown us. So potentially coming down the pike here. Inflation currently is over 4%. Last month, inflation data showed that year over year, we're at 8.6%, and unemployment is below 4%. So when you have those 2 metrics, Larry Summers, our former U.S. Treasury Secretary of Treasury, has said that has a 100% predictive. Every time that scenario has happened, it has led to a recession. First quarter GDP came in at negative 1.4%. from January through March. That's from the Bureau of Economic Analysis. So we are kind of contracting a little bit as an economy. And unemployment has started to actually pick up a little bit from the last couple months. You see the 4-week moving average of initial jobless claims. Jobs were growing after COVID and the market kind of opened back up from the pandemic. We saw hiring kind of go into high gear. And now we started to see companies kind of pull back a little bit, especially in the tech sector. That's where we've seen a lot of the decline in hiring, as well as some of the layoffs. If this becomes more prevalent throughout the economy as a whole, that would be indicative of a recession. So today we're going to talk about a couple things, like how do we protect the downside? Some of the things that are going on in the market today with interest rates, how they correlate to cap rates, what's going on in today's debt markets and how that's affecting deal flow and deals. The state of value add and how to dive deeper in the OM, and some of the risks that might be prevalent with sponsors and deal structures. But as Chad mentioned, I don't want to make this too doom and gloom. So we're going to start out with the good news first and talk about some of the tailwinds that are in the marketplace for multifamily. First off is supply and demand. This is a little chart here showing homes built in the US by decade over the last roughly 100 years. And you can see right after the financial crisis of 07, 08, the next decade, we really started to pull back on the amount of homes that we were able to bring to the market. A lot of home builders during that time, as you're probably aware, went out of business. The financial crisis was caused by real estate and the subprime lending market, and they never came back to the business. So there was an underbuilding going on for almost a decade. And then, of course, this graph doesn't show what happened in 2020 when the market basically shut down, the pandemic struck. So the problem was even more exacerbated. So there really is not enough supply for demand in the market right now. And that is forcing people that may otherwise choose to buy to rent, which is bullish for multifamily. Obviously, demand is a key economic driver of that. Home affordability is another issue. This chart shows the 30-year fixed rate mortgage and how fast it's climbed from the beginning of this year. You can see at the beginning of 2021, it was under 3%. Today, it's closer to 6%. In 2021, the average home price across the nation increased by 19.2%. If you factor in the increased cost of the home along with the increased cost of capital, the debt payment, the principal and interest combined for a homeowner has increased by 50 to 55% year over year, that payment. So that's created an affordability issue. I recently read that this creates almost 18 million people that would have qualified for a mortgage last year that no longer would qualify. So again, people that would otherwise be buyers are now forced to rent. This is from John Burns Real Estate Consulting. It shows basically when it's cheaper to own than to rent. That's highlighted in red versus when it's more expensive to own than to rent. So you can see now towards the right side of the graph there, it's about as advantageous as it's ever been to rent, even though we've seen rents go up considerably as well. They haven't really accelerated to the pace of mortgage payments. In addition to supply and demand and home affordability, we have inflation. We talked about inflation being at 8.6%. The Fed had thought that inflation would be transitory about a year ago. Remember that conversation? Well, that didn't really happen. It's become more of a structural issue in our economy. And when it becomes structural, it becomes almost a self-fulfilling prophecy. This chart is from the New York Fed, and they surveyed consumer expectations. So this is what people in the general economy are thinking is going to happen, not necessarily what will. But people believe that over the next year, starting February 2022 to February 2023, rents will increase by 11.5%. And over a 5-year moving average annualized, they expect 5.2%. So inflation is also a bullish factor for multifamily investing because this directly impacts the net operating income, which is what the property is valued off of. So typically, rents have kept pace with inflation. And oftentimes they've outperformed inflation. Last year, we saw rents across a number of metros get up into the high 20s. And I think Austin, Texas was at like 40% as far as rent growth year over year. So inflation can be a good thing for multifamily to a degree as far as its ability to protect and hedge against it. And then one of my main theses for investing in real estate back in 16, 17 was that the traditional 60-40 stock bond allocation that's touted by the financial industry seemed a little bit out of date to me. Bonds have typically played the role in a portfolio of capital preservation. They've served as a hedge against an economic slowdown. They provided income in a portfolio. and they've provided appreciation potential. I could make an argument right now that bonds are doing none of those things right now. If you look at the returns of the 60/40 portfolio in 2022, negative 15.7%. This is the makeup of a lot of retirees' portfolios. And what happens is that when you get interest rates so low, they really have nowhere to go but up. And since bond yields are inversely related to bond values, when interest rates rise, bond values fall. So they don't provide that same level of protection. If bonds were to rise to a significant yield, they may offer a better investment thesis because they'd actually be paying some income. And then as interest rates fall again, their values would rise. But today that is not the case. And then multifamily has historically held up very well in recessions. So even if we are in a recession or we're headed towards one, the fact still remains that people need a place to live always. So there's some basic necessities in life, food and shelter being two of them. And typically people will pay those bills first before they'll pay away from other things like discretionary income or discretionary expenses, vacations, et cetera, et cetera. So people always need a place to live. And I think if that's in mind, you can see why multifamily is very bullish. And I will add too that there's an undersupply of apartments. There really is just an undersupply of affordable housing for the greater economy. So these are all bullish indicators for multifamily, and we don't see inflation really slowing down quite yet. So still feel like multifamily is a pretty good asset. Do we have any questions regarding some of the bullish indicators? I'll just pause there for a second.
Yeah, if anybody has any questions, you can unmute yourself or you can put questions in the chat. And Paul, I haven't seen anything show up in the chat yet anyway, but.
Okay, I'll just keep running here.
Yep.
Stop periodically.
Hey,
Oh,
yes, sir.
Hey, Paul, that John Burns chart, that was something I never seen before. And I mean, is that kind of like hitting you pretty hard? The blue mountain?
It is interesting, isn't it? You think about how fast rents have risen, and it took a while for them to sort of start rising as home prices rose in 2021, but they've really accelerated. But still today, renting is cheaper than it is to own. So will that flip at some point? Yeah, sure, it could. I don't know. I don't have a crystal ball necessarily, but that is kind of interesting data. I would agree. And I can email that to you, David, after the call here.
Paul, another quick question about the rental demand. Is there a way to get higher granularity about the class of the property, A, B, C, or is that sort of just all property classes combined? Or is it possible to decouple them and look at the individual class?
Yeah, there's a couple of companies that put out more granular data. One is RealPage. They do some analytics that are very granular down to the property class, down to the market. CoStar is another one. These typically are accessed via subscription services, and a lot of sponsors have access to that information, or they should anyways, if they're making decisions around where to invest, because that really breaks things down a little bit more. But that's the data that I have for you tonight. But we're seeing, I have a C-class property that's 100% occupied right now. I mean, there's so much demand. We have applications in queue if there are any openings. It's, from what I've experienced anecdotally, it's sort of across the market that there's demand.
Okay. Yeah, the genesis of the question is if we are kind of, will the headwinds stay the same across all A, B, and C, but as we get into a recession, will it be stronger, for example, in that C class that you were highlighting just for yourself, from a directionality perspective? Yeah.
I'm going to touch on that as we get into the headwinds. Absolutely.
One more question along those lines. The chart about it being cheaper to rent than own, I would assume that's a national number, and that might be not necessarily the case in every market. Would that be a true statement?
Yes, I think real estate is always hyperlocal. The averages you have to be careful with, because every market is so different as far as supply. If there's an abundant amount of supply, those dynamics change entirely. If there's a lot of people moving to the area and it's undersupplied, that's a different story. So depending on the market you're in, absolutely that data can change. That is just looking at it from a super macro, 30,000 foot view.
Okay, thank you.
Okay, so let's talk about some of the headwinds and some of the watch-outs in today's market. That's kind of the interesting thing that's going on right now is you've got these sort of push and pull forces. You've got these bullish indicators we just talked about, but then you also have these risk factors that are really here today. And if we dip into a recession, you're going to see that we maybe need to watch out for these things a little bit more, and it's going to change the market rather quickly. Okay. So first, let's touch on interest rates and cap rates and how they correlate. So interest rates are obviously up. The federal funds rate has moved from 25 basis points up to 175 very quickly. And that has impacted interest rates pretty much across the board. But how does that actually impact property values? Because it's not so simple. Interest rates and cap rates are very heavily correlated, but not on a 1-to-1 ratio, not 100% correlated. So there's this thing called the cap rate spread. And what the cap rate spread is it's the difference between the risk-free rate of return, which is defined typically as the 10-year treasury. Most people think that the US government is not going to default on their obligations, and the 10-year is about as safe of a benchmark for the risk-free rate of return as there is, as far as them committing to their obligations of paying those bonds back to the investors. That 10-year versus the actual cap rate of the market is the spread. So if the 10-year treasury sits at, I think it's at like 3.1 right now, and the market cap rate is at 4%, that's a 90 basis point cap rate spread. And the question to ask yourself is, am I being adequately compensated for the risk I'm taking? Real estate in general, especially private placement real estate, comes with an elevated amount of risk, as you all know. And if the 10-year is risk-free, think of it like this. If I'm getting 3.1 in a 10-year bond versus investing in Austin, Texas in an A-class deal that has a 2.75 cap rate, is that really a good risk-free rate of return? So the cap rate spread can expand and contract. And since they're not interest rates and cap rates 1-to-1 correlated, there could be a scenario where, let's say, interest rates are at 3 and they rise to 3.5%. So a 50 basis point increase. Cap rates were at 4, they may not rise at all, or they may rise to 4.25, only a 25 basis point increase. That is a compression of the cap rate spread in that scenario. And that indicates that investors see real estate as a less risky investment, given all the other investment options they have across the marketplace. Now, if the cap rate spread expands, that's the opposite scenario where people look at real estate as a little bit more risky. And that can be graphically represented here. This is about a 2-year-old chart. It's the best I could find to share here for the purposes of this conversation. But this is the apartment cap rate spread versus the 10-year US Treasury yield over time. And you can see right here, the cap rate spread actually expanded above the long-term average of 2%. This was right after the financial crisis. So this is 2012, when the market viewed real estate as relatively risky, when in actuality, it was probably the best time to buy, interestingly enough. And then here we are in 2020, and it's basically back to the long-term average. This is actually dipped now below the trend line. The cap rate spread has compressed further. Anyone's guess where it's going to go from here. I would estimate that it's going to continue to compress even with rising interest rates, meaning that and I'll show this later, I do believe that cap rates will decompress, affecting property values. They won't decompress as much as interest rates rise. And interest rates are more sensitive to real rates versus nominal. Nominal rates affect single-family home buyers much more so. Real rates are more tied to commercial real estate, and this takes into account inflation. So inflation's at 8.6% for the time being until we get that under control by raising rates. Rates right now are at, the risk-free rate is at 3%, 3.1%. So that's actually a negative 5.5% real interest rate. So some would argue that you're actually getting paid to borrow in that scenario. I think that's kind of a risky outlook, but nonetheless, cap rates are more affected by real interest rates than nominal interest rates. Here's a little chart I put together. This is the impact of interest rates and how they affect cap rates and what could happen to property values if cap rates do decompress. So what's static on this chart is $100,000. That's the net operating income of this particular subject property. If you were to buy a property that produced that income in a market that was a 3 cap, that property value would be 3.33 million. If you bought it in a 4-cap market, it would be 2.5 million. So what this shows is that on the top line here, if this property were to go from a 3-cap and the cap rate decompressed to a 3.5 cap, a 50 basis point change, the property would actually lose almost 15% of its value. And then jumping over here to the right-hand column, the operator's sponsor would have to grow net operating income by 16.67% just to break even, to offset that decline in value due to cap rate decompression. So you can see that the more compressed the cap rate is in some of these super hot markets, the more a decompression in cap rates is going to affect that property's value. And it works both ways too. And it's actually been really beneficial to operators who bought in some of these hot markets over the last couple of years where cap rates have compressed hard. If you're buying in a market that was a 4-cap and it compresses to a 3 versus buying in a market that's a 6-cap that compresses to a 5, you're going to see outsized property value increases. So it's a two-edged sword there. But it is important to know that some of these hotter markets could be affected materially by this. Now, one thing to note that's not really reflected in this chart is that these these lower cap rates are probably indicative of higher end properties, at least B+, A properties. Whereas these cap rates down here, some would find these even hard to find in today's market. But if you're around like a 6, 6.5, that might be a C-class property in Indianapolis, in my market, for example. C-class properties may tend to decompress more so than A-class properties in a recession because investors may view those properties as more risky, and therefore there should be a higher risk premium attached if they're going to buy them. Right now, A-class and C-class properties in some markets might only be 50 to 100 basis points apart as far as the cap rates, which is historically not the case. Normally, investors want a little bit more of a premium to work with there on those C-class properties. So in actuality, a 6-cap or a 5-cap that decompresses to a 6-cap might lose 100 basis points and decompress 100 basis points versus 50, like I have in this baseline scenario. So you may end up with the same property value loss at the end of the day. But I think this chart is kind of powerful and shows, what the downside could be in a decompressing cap rate environment. Okay, so let's talk about debt markets. The debt markets, the capital markets have changed extremely fast. Some of the properties that we're competing on right now, we've had to have engagement from our debt brokers, our lenders, much sooner than we have in the past because things are literally changing on a daily basis. With the Fed raising the federal funds rate so quickly. So floating rate debt is what's most affected by this. If people are taking out fixed rate debt, they're probably fairly comfortable right now. When we talk about floating rate debt over the last few years, the most popular instrument to use and utilize for that type of loan is bridge debt, okay? So bridge debt is essentially short-term financing, 2-3 years long, that is taken out to maximize leverage, to take out debt on a loan to cost basis as opposed to a loan to value. So if you're going to infuse a bunch of money into a value add plan to renovate units and you need CapEx money to do so, it'll cover not just the purchase price of the property, but also the cost to the rehab. So it is an advantageous tool to use. The index that bridge debt's interest rates are based off of is called SOFR. It has become more and more popular versus LIBOR, which used to be used more often. SOFR is the standard overnight financing rate. Back in January, SOFR sat at 5 basis points. Just checked it this morning before this presentation today. It was at 104 basis points. So it's gone up by 20 times in about 6 months. And in addition to that increased cost of capital on the SOFR rate, spreads are up from about 275 basis points in January up to closer to 4.5% to 5% today. So interest rates, much like mortgage rates on a 30-year note, have gone up from about 3% to 6%, which is causing a significant increase to the cost of capital. Why is that? It's because the investors that buy these securitized loans, which are CLO investors, it's called a collateralized loan obligation. How this works is you have an issuer or an originator of a loan. They're able to access funds through a warehouse line, which is basically a bridge, no pun intended, to the CLO investor. They get paid, the issuer, essentially a premium for securitizing these bundles of loans. And the CLO investor is a debt investor, essentially. This is where these debt funds come from. And they're seeing the increased risk in the marketplace, and justifiably so, they want a higher spread to protect their interests and be compensated for that risk. So right now, liquidity is still out there. It is drying up in some parts of the bridge market where lenders have either pulled out entirely, or they're charging so much for capital, their spreads are even higher than what I've illustrated here. They've made it so deals just don't pencil whatsoever, just to kind of get themselves out of the space. But there are still lenders lending in the space. Point being is the market sees the risk. And to mitigate against some of that risk, there's a couple of ways to do it as the borrower. And really you're sort of forced by the lender to take out these risk mitigation tools. But rate caps is one of these. Rate caps are essentially issued by banks. The borrower will get a strike price, essentially, where if SOFR goes over a certain percentage, whatever it is that they end up paying over SOFR, they essentially, over that strike price, I should say, they're reimbursed by the rate cap. So on a $20 million loan, for example, a rate cap in January might have been $80,000. Well, today, that same rate cap is running at about $800,000, 10 times the price. So that's just reflective of lenders and banks not really knowing where interest rates are going and wanting to make sure that these rate caps are actually profitable for them and they're not paying out so much money as insurance against rising interest rates. And then borrowers also have the option to get extensions if they can get them, where their bridge term is 3 years. They have the opportunity to buy an extension of 1 year or possibly even 2. And that costs money as well. But if the economy isn't in a good position to sell the property, to refinance it, those extensions might come in handy. But even so, at some point, there is maturity risk in a rising interest rate environment. And it can come in two forms and fashions. One would be a takeout loan for refinance. At some point, the operator's plan may have been to stabilize the property through their value add renovation plan or their operational strategy, improve net operating income, and then take out permanent financing. And if their bridge term was 24 months, 36 months, and they get to the end of it, and they didn't on the front end at the pro forma account for a 6%, 6.5%, 7% interest rate where we're headed, their loan proceeds are going to be much less. The return of principal to their investors is going to be nil or much less. And their returns that they anticipated on the pro forma are not going to be hit. Hopefully they're able to get a permanent loan at best. And then another scenario that could happen is maybe they budgeted for a quick flip. That was their initial plan. And 2.5, 3 years later, when their bridge term comes due, the terminal cap rate has expanded. That's the multiplier, as you know, that's applied to the net operating income that gives you the value of the property. And if it's expanded at a rate beyond what they've compensated for in their pro forma, they're going to get a lot less at the sale, and their returns are going to be a lot lower too. It's traditionally been sort of widespread that most sponsors will add 10 basis points for every year of their hold period. I would argue that that's not adequate in today's environment. We could see, if interest rates rise by 300 basis points and the cap rate spread compresses, as we talked about earlier, but rises, 100 basis points, that's going to be a lot more than most sponsors have budgeted for in their pro forma. So a couple of watch-outs that are big ones right there when it comes to using bridge debt in today's market. Floating rate debt is not the best instrument when interest rates are rising. So along with rising interest rates, we're also seeing lower leverage. How lenders measure risk in a deal is through two key metrics. One is debt service coverage ratio, which you may have heard of. That's widely used in the single family space. If you've ever taken out a mortgage on your primary residence, essentially they want to know in that scenario, what is your income and can you support your home payments? In this case, the lender wants to know, can the property's income support the amount of debt service that's due on an annual basis? The problem with this metric for lenders is that it can be easily manipulated. If your amortization period is extended from 20 years to 30, that's going to lower your annual debt service amount which makes debt service coverage ratio go up. But then that's good for lenders. But does that really lessen the risk in the deal for them? Not really. So debt yield is becoming more of a popular metric used by lenders. And that looks at net operating income divided by the total amount of debt that was taken out of the deal. And it's similar to like a cash on cash metric used by investors. Essentially, if the lender had to take back the property, how much or how many years of income would it take to pay that debt down is what they want to know. And what's interesting and why I bring this up is because in January, going in debt yields for bridge lenders, the requirements that they asked for were around 4%. Okay, so that's pretty low, but they're realizing that the property is not stable and there's a value add potential plan here. Today, those going in rates are closer to 5 to 6%. And then at maturity, 3 years out, in January, they wanted 4% going in. At maturity, they wanted about a 7% debt yield. Today, at 5 or 6% going in, they're now looking for 8 or 8.5% at maturity. So as debt yield goes up, loan proceeds go down. So along with bridge debt having a lot more risk and a higher interest rate, leverage has been affected across all debt instruments. But we're seeing right now bridge debt lenders going up to like 65%, maybe 70% loan to cost. There may be some other products out there that I'm not seeing, but that's what we've seen as of late. So with all these risk factors in the marketplace surrounding bridge debt, we're seeing a return to fixed rate debt. And this is provided by agency, commercial mortgage-backed securities, life insurance companies. These are more, they're balance sheet lenders. They're not pro forma lenders. They're not looking at what's the future income that this property could produce based on the sponsor's value add plan. They're looking at in-place financials day one. So leverage on these debt instruments is actually lower. Agency debt is closer to 50% loan to value today. So much lower leverage across the board, which is good in a sense because it provides additional security to the borrower and to the investors. But what it means is that there's likely going to be longer holds because, agency, for example, these are 5, 7, 10-year products. There's significant prepayment penalties in the form of yield maintenance or defiance for life insurance products. And with that, operators, if they choose to exit, pay a significant penalty to do so. So with that, you're going to see longer term holds. Okay. You're going to see, instead of these, 30% IRR, 15-month turnarounds, it's going to be more like a 5-year hold. And, maybe it's 14 to 18% IRR. So lower returns, those are really the only two ways to go here. Either with lower leverage and higher debt service, you're either going to have to expect lower returns as an investor, or sellers are going to have to come down in pricing, which means that ultimately cap rates are going to decompress. So it's one or the other. And I'm not trying to paint a horrific picture here, just that we've been on this ridiculous bull run in multifamily over the last 10 or 12 years, and we can't expect that to last forever. But if you look at a 14% IRR, that's risk adjusted, that's protecting the downside, that's a heck of a lot better than I think you can get in a lot of other assets out there. So, still a good investment, but just that's my expectation for the market moving forward. So with that, I would suggest only allocating truly illiquid portions of your portfolio. That's probably true across any syndication for any hold period, because usually the sponsor has last say in, when the deal, when is the ideal time to exit, and that could be longer than the initial plan. But with longer holds, you want to anticipate that money being going bye-bye for a little while. And you also have to anticipate having a long-term relationship with the sponsor, 5, 7, 10 years. Do you want to be tied to that person for that long? But generally speaking, fixed rate debt is a safer instrument if used correctly with these longer-term hold strategies. Another thing that you may see start to pop up more is sponsors investing or bringing to market assumption loan deals. These are basically loans that can be assumed from the seller. So they may have bought the property 3 years ago. Properties have appreciated significantly. They have 7 years left on their loan term. and they've locked in an interest rate in the 3% range, which you can't get today. So these can be attractive deals where you may actually end up with, it may be a good deal for the seller because they're going to get a good purchase price. It's going to get reappraised. That loan to value might come in the 60s, but that's really higher than you can get today. And you might have a lower interest rate than you can find today too. So assumption loans, I think, are going to be a popular way to get deals done. I actually invested, the only deal I invested in this year as a multifamily passive investor was a deal in Dallas, Texas, where the operator assumed the loan. And that was one of the key metrics that I liked about the deal. And then this is one-on-one here, but debt should always match the business plan. If you find an OM that talks to the point of exiting the deal in 5 years and they're using 10-year agency debt, that's a red flag. There's going to be a massive prepayment penalty to get out of that deal unless that's been underwritten into the deal, which would probably kill the deal no matter how unrealistic rent growth projections or any other projections are that the operator could put in there. You should probably walk on that. You should really know that the debt is going to match the business plan in all cases, recession or not.
Hey, Paul, real quick. Yeah. There was a question that came up on bridge loans before you get too far away from that. Sammy, I saw you had your hand up. Do you want to ask that question?
Sure. Thanks, Paul. I've seen a lot of, the 3+1+1 structure on the bridge loans. And I also understand the interest rate caps maybe are for 2 years or for a shorter period. So I'm trying to understand how those play out going forward. What are the sponsors projecting? Typically, there's not much visibility on how they're hoping to play things, in year 3 in terms of extending the bridge loan and also perhaps needing to require new caps. I have heard that the bridge lenders will require, if we assume interest rates are going up, they'll require a larger kind of cash reserve. But I'm just trying to understand how the timing, is there a risk that the deal falls apart, let's say in year 3, or are the cap rates typically also for 5 years or with a 3+1+1 structure?
Having not utilized that sort of structure, I can't speak from experience on that, but my understanding is that there's sort of a strategy around when to buy these rate caps. And it may be that, you buy a 1 year rate cap and then you wait to the following year to buy the next one, because maybe you feel as though there'll be less uncertainty in the marketplace around interest rate risk. Even if rates have gone up significantly, there's less uncertainty. And that's really why rate caps have gotten so expensive lately, is because there is uncertainty amongst lenders. A couple of weeks ago, we were like, what's the Fed going to do? Is it going to be 25 basis points? Now it's probably going to be 50. It could be 75. So that type of uncertainty creates an extra additional expense for these rate caps. So how I've heard of sponsors doing is they may buy them at a strategic time. They may buy 1 or 2 years at a time. They can re-up. They may have to at a certain point and take the risk of waiting 2 years to buy that 3rd year cap. So it's really dependent on the deal and the sponsor's kind of strategy on how they approach that situation. Does that answer your question?
Yeah, so in other words, rate caps are just an entirely autonomous or separate kind of time period based on sponsors' kind of view of the future, rather than kind of being tied to the 3+1+1 structure of the bridge debt.
That's correct. They're two separate things, if I understand your question correctly. And what's interesting too about rate caps is once you buy them as the sponsor, you own it. So if you do exit the deal and you still have this rate cap that runs for another 18 months, you can actually sell that rate cap. There's a secondary market for these rate caps. They're sold by banks. That's, again, not something I have experience with, but there is some value attached to that rate cap, especially in what is a rising interest rate environment.
Got it. Thanks.
Okay, so let's talk about value add today. We're switching gears a little bit. I think value add might be one of the more overused terms in all of real estate investing today. Every deal that comes across my desk is a value add. So how do you know whether it truly is a value add deal? Well, there's a few metrics that I've found to be useful in the value add space that are typically thought more of in the development or ground up space. And I think they can be applied to the value add space very easily and help identify, am I really adding value? How much margin of safety do I have? And actually putting a percentage increase on a predicted value you can add. One of those metrics is The presentation just froze up. There we go. One of those metrics is yield on cost. Okay, yield on cost is pro forma net operating income. So this is not the going in actual financials. This is when the operator anticipates net operating income being stable. That number divided by the total project cost to include the purchase price of the property, including the debt, all the soft costs, the working capital, the reserves, and the cost of the CapEx, so the total project cost. Okay, and what you want to see is that the spread between the yield on cost metric and the market cap or the terminal cap rate, you want to see that there is a spread. It should be higher. And that spread is called the development spread. And that lets you know and indicates to the sponsor that this deal, they are in fact adding value to. And then to turn it into a percentage, which is called the development lift, you take that spread above the market cap rate and you divide it by 100 and then by the market cap rate, and that gives you a percentage. So we'll go into some examples of that in a minute to make some clarity around that, because I think that's not easily understood just in wording here. But before we do, another metric that I think is really powerful to evaluate, and by the way, these are not typically seen in offering memorandums, so this is stuff you may have to calculate yourself, or better yet, ask the sponsor during a call, ask them over a webinar, what's the yield on cost of this deal? And if they don't know, then that's not a good sign. IRR partitioning. IRR partitioning is, I think, pretty popular in this group. If I'm not mistaken, Chad, don't you guys have a calculator that can help?
We did. We built one into one of our tools, our deal analyzer tool. There's a ability to utilize that. Steve was our founder of that brought it to the group for us.
Nice. Yeah, I think it's a powerful metric, and it's really somewhat subjective in a sense, but what it allows you to do as a passive investor is understand, okay, the sponsor's calculated this IRR, that's predictive of future returns. How much of that is derived from cash flow of operations, which is much more real, tangible, much more calculatable, versus the exit sale price, which if you're selling in 5 years, you're anticipating a lot of different assumptions, and that's not as sure of a thing. So IRR partitioning breaks it down into those two buckets. If you've got a deal that has, let's say, 10% of the IRR derived from cash flow and 90% from the sale, that's more indicative of like a development deal. If that's a value add deal, that's probably too risky. That's assuming that you're going to get this big sale price that's going to bail you out at the end of the deal versus actually a cash flowing property. If you're more in the 50-50 range, that's a pretty good balance and indicative subjectively of a safer, more conservative deal. Okay, so let's, and that's what this is all about, is margin of safety and being compensated for your risk. So let's talk about a value add example in calculating yield on cost. So here's some assumptions. Let's say the subject property is in a 5 cap market. We're going to buy the property for $20 million. And this does not assume any working capital or soft costs, lender costs, et cetera. Just for ease of this example, I left that out. The in-place going in NOI is $900,000. That's what we can expect today as we buy the property day one. That's actually calculated out. If you take 900 and divide it by 20 million, that's a 4.5 cap. So that's the going in cap rate. And you'll see that that's actually a little bit lower than the market cap. So does that mean we're overpaying? Not necessarily, probably not. In a value add deal, you're paying the seller for a growing income stream, to the opportunity to buy a property with a growing income stream. So it's very common to see in place cap rates or going in cap rates lower than the market cap, but you obviously want to get that higher than the market cap and ideally higher than the projected terminal cap rate or exit cap rate to give you that margin of safety. So in this example, let's say the sponsor thinks they're going to take that $900,000 in place NOI and jump it up to 1.1 million once they finish their value add plan. They're going to have to spend $2 million to do it on CapEx improvements. And that brings the total project cost to 22 million. So if you take that 1.1 million, divide it by 22 million, you've got a yield on cost of 5%. That's a red flag right there, okay? Because that's the market cap. So we just paid stabilized pricing for unstable products. Didn't really add any value to the deal. That's not what you want to see when you spend 6, 12, 18 months putting sweat equity into a property and taking the risk of stabilizing it. You want to make sure you're getting some yield out of that via the yield on cost metric and the development spread. Okay, same basic example here. The only things I've changed are highlighted in yellow there. Let's say instead of 1.1, we think we can juice the NOI up to 1.3 million. In this case, we can calculate 1.3 divided by 22 million to get the yield on cost of 5.9%. We know that the market spread is, or excuse me, the market cap rate is 5. So we're getting a 90 basis point development spread above the market cap rate. That seems pretty good, especially let's say cap rates decompressed by 50 basis points. You still have another 40 basis points of insurance that you've added, value in the property that if you had to sell it that day, it would be worth more than what you have into it. And in this example, the development lift expressed as a percentage is 18%. So if we could execute on this plan and this vision, the result would be an 18% increase in property values, again, based around some assumptions. So you got to remember to always ask questions about the assumptions. Are they realistic? But you can extract this data as a passive investor from an OM, and if there's not enough information in the OM, you can ask the sponsor and kind of get a gist for how they're thinking about these value add deals. So in this case, we've added a margin of safety and added true value.
Hey, Paul,
Okay,
can you remind us what year are you using from the pro forma data as well? Are you using, you're not using initial year data, you're using kind of the assumed, I'm missing the term. When
Pro forma and net operating income?
Yeah, the stabilized number is what you're really shooting for, whatever year they estimated it'll be stable. Is that fair?
That's right. Yeah, you want to know what is this property going to, what kind of cap rate is this property going to be operating at? If you can operate a property at a 6 cap in a 5 cap market, you've got 100 basis point spread. Because when you sell it at a 5 cap, you're selling it at a lower cap than you're operating it at, which is indicative of a win. That's a profit, if that makes sense.
Yep.
Paul, this is David Banks. And so the thing that I've always on yield on cost struggled with is they don't just always come out and tell you this is the year of the stabilized NOI. So essentially to get that number so that you're on the same page they are and your yield on cost number is accurate, you've got to ask them what they consider to be the stabilized NOI year, correct?
Yeah, you need to know, that's a great point. When is this value add plan going to come from fruition and when is it going to commence? And you'll see a lot of times baked into these pro forma assumptions that they're getting, for example, they're burning off loss to lease and they're getting their pro forma rents all in year 1. And that's very difficult to do, especially if you have, a property that's pretty solidly occupied. So imagine a property that's 95% occupied and you're going to go in and you're going to renovate 30% of the units. You have to wait till leases end before you can roll people out of those places. And you're going to displace tenants. It's a big job. So being realistic as a sponsor as to how long it's going to take to actually execute the plan is something to take into account and something that passive investors should look at too. We've renovated some vacant properties, and honestly, or I should say properties that have higher vacancy, where I went in one time on a property that was 70% occupied. And we intended to renovate 30% of the units. Well, 30% of the units are not occupied. So we're able to kind of control the rehab and get in there right away and accelerate the process, which I really liked. But if you're occupied, which is a good thing because you're producing income from the property, it may take longer to do that. So yeah, you want to understand what their plan is and when that pro forma NOI will take effect essentially.
By the way, I think yield on cost is a great metric to use, like you said, in figuring out if the operator really understands the plan and is being realistic in their pro forma. Robert Beardsley also uses yield on cost to evaluate deals. So great catch there.
Thank you. Yeah, and I've met Robert and I've read his book. I forget the name of it. If you haven't read it, it's pretty granular. It's called The Definitive Guide to Underwriting Multifamily Acquisitions. It's here on my bookshelf. I'd highly recommend it if you want to get a deeper dive into some of these topics. But yeah, yield on cost has become probably my favorite metric to calculate whether or not I'm wasting my time, in trying to force value into a property, or if there's actually some meat on the bone there. So.
Go ahead, hey, Paul, I want to do a real quick time check. We're about 3 minutes away from the top of the hour. Just want to be sure we stick close to our time and allow some little more questions, we will do a follow-up after the call with some networking. But wanted to gut check you on that just to keep you honest. Good
Okay.
questions, good content. Keep rolling.
Let me just rip through this then as quick as I can. Be careful of D-class properties being marketed as B-class. Make sure your sponsor knows the market. Because of the competition in the space, people are expanding their geographic criteria, and they may go into areas that they don't necessarily know. I've witnessed that firsthand. Know that if we enter a recession, there's some risks among different property classes. If it's an A-class property, these are newer builds. They have all the luxuries and amenities you want, but they come at a premium for the renter as far as price. If they lose their jobs or the economy starts to pull back a little bit, maybe commissions are down, they may decide to move into a B-class property. So that could drive increased vacancy in an A-class space or an A-class property. C-class, these are people that are living paycheck to paycheck in a lot of cases. If they lose their jobs, that's going to be difficult. They're going to choose to buy food before they buy rent or pay rent. So just understand the property class risks as you look at different assets, and understand that the sponsor, they really need to know the market to know whether it's a B or a C-class property. Emerging markets of today can become the biggest risk markets of tomorrow. Be wary of loss to lease as a value add strategy. Let's say your property that you're considering investing in is getting $900 a month for rent for a unit, and there's low supply in the marketplace. And there's a property up the street that looks very, very similar that's all of a sudden gotten a couple of leases at $1,100. A lot of times brokers will market to sponsors that is the new market rent, and they can go in there and they can burn that loss to lease off immediately. Their rent should be at $1,100 right away. They don't have to renovate anything. They just can roll those leases over. If the tenants don't want to live there anymore, they'll get somebody else to come in at $1,100. That has been prevalent. I've seen that a lot in Florida deals, actually, specifically because we look in that market. Loss to lease is dicey. If you get into a recession, don't assume that the operator can get those top rents that are just floating out there just here and there. Make sure that they're adequately budgeting and looking at rent growth accurately. We've had immense rent growth over the last few years. That's likely to slow down. By how much, we don't know, but if they're budgeting 6-7% rent growth year over year for 5 years, that's probably too aggressive. And if they're not budgeting for expense growth that is commensurate with rent growth, they're probably being unrealistic as well, especially when it comes to taxes and insurance. Prices of everything are going up, particularly those two buckets right now. Governments want increased revenue, and insurance carriers are kind of pulling out of the market as far as multifamily goes, particularly along coastal markets and areas that have higher losses. So insurance has gone up like a rocket. Just be sure that they're budgeting for these types of things. Material costs are fluctuating because of supply chain issues. Just basically don't pay too much for a future rent roll. Those are the watch outs I've got. Make sure your interests are aligned. I'm not going to go into this too much because this is going to take too long, I think, but just know that sponsors don't make money without deals. Make sure that there's not a big conflict of interest. It's easier to spend money that isn't yours than your own. And sometimes these people want to continue to grow. They want units. They want their business to flourish, and they lack the patience to realize that there's a difference between entrepreneurship and investing. So be sure that you kind of understand that. I'm going to skip through this. This is something I definitely want to cover real quick because I think it's powerful. I calculated a deal that was 14.4% IRR based on these four all-important metrics: LTV 75%, annual rent growth of 3%, hold time 5 years, and the exit cap rate of 6%. If I changed each one of those inputs respectively, independently of the others, you can see what it does to IRR. IRR is very easily manipulated on a pro forma. If I went from 75 to 80% leverage, I'm up to a 15.9 IRR. If I go increase rent from 3% to 4%, now I'm up to a 16.4. If I decrease the hold period, because IRR takes into account the time value of money, my IRR shoots up to 17%. If I decrease the cap rate when I sell to 5.5, instead of 6, my IRR is at 16.9%. And if I use all four more aggressive assumptions, my IRR is now 23.9, from 14.4 to 23.9. So a deal is risk adjusted in the eye of the beholder. These assumptions may or may not be realistic. This is obviously more conservative, but just realize that when you see advertised IRR numbers, that they don't necessarily mean that that's what you're going to get as an investor on the backside. Understand the inputs that lead to those IRRs and how easily they are squeezed. That is a term that's used in the industry. We're going to squeeze the spreadsheet to get as much out of it as we can. And really all else I had was just some summary here. You know, be wary of who your operator is, understand the difference between somebody that's a real estate professional that operates the property versus somebody that's just raising capital for other people's deals. And this just kind of wraps it all up. Understand the risk of the debt. You know, the lender brings a lot of the money to the deal, most of it, in fact. Make sure that you're comfortable with their structure and the business plan. Know the sponsor really well and the market really well. Look for what is not presented in the offering memorandum. Mine for that stuff and ask the sponsor difficult questions. Be selective and don't be afraid to sit on the sidelines for a little bit in a portion of your portfolio in cash and wait for opportunities. Again, I'm not saying that multifamily is a bad investment right now. I think actually this is the part of the market cycle that we've been waiting for on my end, because last year was a free for all. A lot of people were paying top dollar for properties. And now if you can structure deals to be all weather, to protect the downside, to be cash flowing on the front end and just hold for a little bit longer, you can get some really strong value, I think, in today's market, even given the headwinds. So that's all I have. I really appreciate the time today, and hopefully you guys got a lot out of the presentation. I'm happy to answer any questions, time permitting.
Yep, Paul, that's great stuff. Really appreciate you coming on and sharing all this great information with us. Any questions out there? I will say, Paul, I don't know if you have time. We usually jump over to Wonder Me and do networking out there. If you're available, we'll put you in the multifamily section and people could come in and ask you questions there too.
Sure. I just got a link from Steve. Do I just click on that?
Yep, and that'll get us there. He probably has a password coming up too after that, but yeah, there we go.
Very good.
So yeah, if people want to jump on Wonder Me, just to be mindful of time, I'd rather push us over to that and people can jump if they need to go, or they can come on and ask questions on Wonder Me with us. But feel free to come join us and network on that side of things too. But Paul, really appreciate you jumping on. Great information tonight. You can maybe do some yield on cash examples for us in the Wonder Me section. I'll give you
the opportunity. Thank you.
Yep. Cool. Okay, so people, you're more than welcome to jump on to Wonder Me with us. We'll move over there and do some networking now.
And by the way, you can actually use your phone now on wonder.me. They just updated their website, so you don't have to be on a laptop or a computer. So you can just use your phone to jump on this link. All right.
Very good.
Thanks again, Paul.
Thank you, guys.
We'll see you on the other side.
All righty.
Thanks.